Our next guest says earnings are providing a constructive backdrop for the stock market. Let's bring in David Smith, Chief Investment Officer with Rockland Trust. The interest rate conversation pretty much frames everything these days. They do kind of help with the earnings story. Is the earnings story enough to drive the markets higher?
Well, I think it is, Don. I mean, at the end of the day, ultimately, investors are looking at cash flows generated by companies, and companies generate cash flows through earnings. And the earnings expectations looking out, we're just starting, obviously, the first quarter reporting period, but they look pretty robust. They look like low double-digit earnings growth for 2020, 2024 and 2025. That's a great backdrop for stocks, for sure, despite all the mixed messages that we're getting out of the Fed. And in the data, again, another data point today where that labor force increase, the price increase in wages is very compelling, very surprised to the downside, which is good news.
So does that mean that you are tilting your strategy towards more economically sensitive type stocks, or is this an environment where inflation's a problem and you got to be more defensive? And if so, what's on the shopping list?
Yeah, so we tend to look long term, Dom. We're not, traders, and so we're thinking out, 12 to 24, even longer sometimes when we're making investments. So we're not skewing our portfolio so much right now based on near term factors like the labor print today. When we think longer term, we want to have a good mix of those things, right? So we want to have some exposure to the rapidly growing sectors. AI is a phenomenon that's going to be around for many, many years. We want to make sure we have companies that are exposed to that, but at the same time recognize that at some points in the market cycle, some of the more traditional cyclical companies are going to do well, and we want to make sure we're participating when that happens as well. So right now, I'd say we're not skewed in one way or the other. We're kind of balanced across those two categories, and I think we're well positioned for whatever comes our way with regard to inflation and its impacts on interest rates.
How closely are you paying attention to jobs at this point in time? And do you think that this morning's numbers was enough of a degradation to get a cut as soon as July?
Yeah, so I don't worry so much about the jobs numbers themselves, but the wage inflation numbers really, really important. If you think about it, if we had a limited amount of goods and services in the economy and everybody's making substantially more money, the only thing that can happen is prices rise. And when prices rise, that's inflation. So we're looking very closely at that as an input to overall inflation. The jobs numbers themselves obviously have some impact on that. To the extent that there are good, solid job growth and relatively low unemployment, that's going to put more pressure on that pricing. But the pricing itself, the wage growth is really something that we're very, very focused on to try to understand the bigger term trend in inflation.
Yeah, and of course that came in below expectations, but growing nonetheless. David Smith, really appreciate your time. Thank you.